Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and joining me in the studio, we have Dale Colclaser. He is the president of wealth management at Retire Path Wealth, and Mark Smalling, who is the co-founder. We've got a great show for you today. The title of today's show is How to Remove Your Wealth from Washington. If you're uncertain about what your potential tax liability and bill might be, and you want to take steps even today to start minimizing that for now and in the future when you're in retirement, you're not going to want to miss today's show. Dale, Mark, I'm excited to have this conversation with you. It's going to be a good one, isn't it?
I think so.
I love taxes.
I know you do. I know you do. You are fired up. You're just ready to go. Well, let's get into it, because here's the frustrating thing for most folks is that you've been working hard your whole life. You've been putting money away, and it can be really discouraging when you realize that you have this massive wealth that has been accumulated. For most folks, it's in these tax-deferred accounts, right? So the tax bill has not yet been paid. And we also are subject to legislative risk, meaning we never know what changes are going to happen in Washington, and especially with it being an election year, that can be really hard for folks to navigate. So we're going to get into it today and ultimately help folks know how they can remove their wealth from Washington. Are y'all excited to have this conversation?
Oh,
every day.
Yep. And you're having it every day, aren't you?
Yeah, well, you have people come in and almost all their money sitting in a qualified account, and they go, we've got this much money, and Dale always goes, no, you don't.
and that's a hard reality. That's a hard pill for folks to swallow, right?
Sure it is. Well, because again, you go and you look at your accounts, and they knew that they've been up and they've been down, especially in this market volatility we're seeing in the market so far at the end of this year as well. And then due to the fact that maybe 72% of it's yours, maybe 80% of it's yours, maybe 60% of it's yours, just depending on how you have those distributions set up. And so many times we have people come in and says, hey, well, what is your written income plan for retirement? And they're like, oh, well, literally had a lady this year said that she had called her current advisor, said, hey, I'm going to retire at 65. And he goes, well, I hope you can live on $682 because that's what you can take off of your account each month. Wow. And it was like, I said, so where did that planning come from? And she goes, I don't know. And so, again, that's why we kind of start, why we always want to start with the plan part of the process first. And then we're going to go back and we're going to implement investments and coverages and all those different things based on what our needs for the plan are. And so we're going to take a proactive approach of figuring out what we need to do and then try to develop a tax-efficient distribution plan for how to get that money out of there.
Well, gosh, so much to get into, and I've kind of gotten ahead of myself here because I think it's important to set up a couple different things for folks. You've already kind of touched on why it's so important to pay attention to your potential tax bill in retirement. But one of the things I think that it's important for our viewers to understand is that you all are not CPAs.
That's right.
You're not accountants, but you do engage in strategic tax planning for your clients. Talk a little bit about what we mean when we're using that terminology and why that really sets you and the team of Retire Path Wealth apart.
What we're going to do is we're going to take the effect that taxes have on what we do, we're going to approach that in advance. So we're literally going to build an income plan based off of what our income need is, not what, oh, well, I've been making X number of dollars. I want to know what your net need is. We'll do the tax calculation back. And the idea is if we can build a more efficient distribution plan, then we have to access less of the assets that we have to accomplish the same need. Especially, again, I'll mention it again, a year where we have the volatility that we do. If you're in traditional mutual funds, you're going to have activity that occurs throughout the year in that plan that's going to cause taxes that you're unaware of and possibly your non-qualified accounts. Non-qualified accounts can be one of the better tax opportunities that you have, at least under today's tax code, because in 12% or less regular income tax brackets, long-term capital gains are taxed at zero. Qualified dividends are taxed at zero. We want to make sure we have money set aside in a Roth. If you've been told out there that Roth doesn't make sense for you because you're too old or simply because maybe you're in the wrong income tax bracket, then maybe you haven't been given all the right information. So many people think I have to put money in on a pre-tax basis and I can't do the Roth because my employer won't match it. Those things are not necessarily complete information is a terminology we like to use. Yeah, it may have been based on some truth, but it's been expanded from there. And based on how your overall situation is set up, we need to look at the tax implications in everything, not just in income, but also in Medicare, as we discuss so commonly as well.
Right. Well, gosh, we're going to go through some lists of the non-taxable types of income that the IRS can't touch. That's why today's show is called How to Remove Your Wealth from Washington. But so much goodness that you just said right there, Dale. Let's first start off with Roth accounts, because we've been using the term qualified accounts. That also means tax-deferred accounts. I always like to think qualified accounts means it's qualified to pay tax, meaning you have not yet paid the tax on it. Non-qualified accounts, that's where the Roth accounts come in. So talk about that, because, to your point, there's a lot of misconceptions out there of who can or can't maybe, be able to use a Roth account. So let's help folks understand that first one.
Right, and I mean, we have people come in the door every day and they say, well, I can't do Roths, I make too much money. A lot of people have them in their 401ks at work, and they don't even know that they have access to it, or they think that if they make a contribution to the Roth, that they're not going to be matched the same way by their employer. There's a lot of misconceptions about how things work with that. But there's general guidelines that follow a Roth. You just like a traditional qualified plan, you can't take money out until 59 and a half without penalty. They do have to be in place for 5 years so that the growth on your Roth comes out tax-free also, not just what you put in that. And so there are guidelines, but people think with a Roth conversion, when you start talking Roth conversion, they think all the rules about Roth contributions apply, and they don't. Right,
I'm glad you brought that up. So yes, there are income limits for a Roth contribution, meaning just a Roth,
a traditional Roth
traditional
IRA.
Roth IRA. That doesn't apply, though, for Roth conversions.
That's correct.
So explain this strategy, because I know you do this for folks day in and day out, and who's the best candidate and how that actually works.
Yeah, the reality is there is no income limit. No income limit, okay, for the Roth conversion, okay? The reality is I just have to have money that's outside of my qualified plan. So I appreciate, again, kind of bringing up that distinction is I've got to have money that's an IRA. I can't convert directly from a qualified plan or an ERISA, a 401k, a 403b, something that's in place with my employer. I can't make that distribution. So I need to be able to have money either in an IRA, or if you're 59 and a half years old and you have in-service distribution options, we can take money directly from the 401k, roll it over, which is a non-taxable event, to a traditional IRA account, and then make the conversion from there. The reality is the most common that we see is once we've already done the written income plan, we've gone through all the process, and we realize, hey, 35 years down from the road, there's this large sum of money that's still left over that we personally don't need to accomplish the goals we've set for ourselves. I'll go ahead and let the cat out of the bag. Inheritance, okay? It's the money you're going to leave to your kids. And the idea there is that if I have an efficient way to distribute some of that money out in lower tax brackets today for Roth conversion, maybe it's not just for my own benefit, but it's going to benefit distribution for those kids later. Because the reality is, as I tell people all the time, we're not going to pay taxes to avoid so our kids don't have to.
Right.
Because it's still your money. They're paying the taxes on. It's what you accumulated.
Right, you're passing on that tax burden to them, right?
That's right. We want to be efficient because it's what we've accumulated. We want to see those that we want get the best advantage of that. So what about if we convert some of this up? If we have charitable aspirations, we want to make sure that maybe it's a qualified money that's still taxable that we leave to the charity. Or if we're past 70 and a half, and I know I'm jumping out of order here again, okay, forgive me, I just do that. But the idea is if I'm 70 and a half years old and I'm charitably minded and I'm not making my IRA or my charitable distributions directly from my qualified money, folks, give us a call right now. Scan that QR code. We can fix that because that's the most efficient way to get money out of those IRAs.
Yes. Well, I know we have a lot more to talk about today on how to remove your wealth from Washington, but you just mentioned, having folks call in and come and meet with you. Talk a little bit about this complimentary tax review that you're offering to our viewers this weekend.
Yes. So I'm going to reach out to everybody that feels like maybe you don't really understand how your tax situation works. You want to get a better handle on it, and you want to understand why you should be doing what somebody's telling you to do, or nobody's told you to do anything yet. So what we want to do is we want to sit down and we want to look at your current income situation. We want to look at your asset scenario, and we want to make a future assessment on your taxes. Your CPA is going to look at your taxes each year. They're going to account for what you've already done to make sure that you file your forms properly. What we want to do is put a plan in place so that we can minimize the effect of taxes on your investment structure, on your income flow, to benefit you today, and then take into consideration what changes may come in the future.
Wonderful. Dale, Mark, I love how fired up you all get, how passionate you are about helping folks mitigate their tax liability.
Right.
The reality is we don't want you paying any more to the IRS than you are legally required to pay. So we encourage you to reach out and schedule your time to come in to receive your very own complimentary tax review from the team of Retire Path Wealth. To claim yours, all you need to do is call that number you see on the bottom of your screen, 866-724-3893. Or if you'd rather connect online, just take out your smartphone, and if you open up that camera app, you can point, click, and scan the QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Retire Path Wealth will reach out to connect with you to schedule your complimentary tax review that way as well. When we come back, we're going to be going through some more ways for how you can remove your wealth from Washington right after this.
I became a financial advisor through a referral from my financial advisor. I was leaving a career in the corporate world and basically was looking for something else to do. And he said, hey, don't you have a finance degree that maybe you can put to good use? I went to college, was supposed to be a dentist. And physics and organic chemistry changed that path. I think it was the realization of of having worked somewhere long enough to know that I didn't want to have to work for someone else, that I was looking for more an entrepreneurial career path, and the opportunity for financial planning offered that, to where I could basically have my own practice at that time. Started one of the biggest financial planning firms out there. There was a lot of positives learned from there, but also learned a lot of things that didn't really line up with my sense of belief, and knew that there were others out there that probably felt exactly the same way. So even though I learned a lot about the industry, I also began to learn that a lot of financial advisors are taught the industry by the vendors and wholesalers themselves, and came to the understanding that a lot of what we consider to be general consensus advice is really based on those techniques that are benefiting those that are teaching, not necessarily those that are investing in those products.
Welcome back to Arkansas Money Talk, where today we are talking about how you can remove your wealth from Washington. I'm your host, Kristen Oakley, here with both Dale Colclaser and Mark Smalling from Retire Path Wealth. And that's the whole point of today's show. We want to be able to share with you ways of different types of non-taxable income, ways that you can lower your tax burden both now and in retirement. So we talked in the first segment all about Roth conversions. I know that's a strategy you're able to do a lot for your clients. Obviously, a lot goes into that strategy. We don't ever recommend people do this on their own, because there are so many different things that have to be done correctly in the right order with the right timing. Let's talk now. Another type of income on this list is financial gifts. So share first about the gift tax limit.
Okay, so the idea is in 2024, our gift tax limit is $18,000, okay? I always want to make sure that people understand that when we talk about gift taxes, it's removing taxes from the giver's situation. And that's why you want to make sure to adhere to those limits, because the giftee, the person receiving the gift, never has taxable income in that situation. But it's simply a way of removing your long-term wealth, potentially, from taxation. Could be another situation for people who are looking into RMD issues at some point in the future. Those required minimum distributions we have to take out of our IRA accounts, because IRA dollars are not the best giftable options, at least not in this status that we're talking about, because typically now we're talking about gifts to family, but those non-qualified assets, and then taking income efficient distributions from our IRA accounts to go replace that money in our liquid savings as well. Even outside of the gifts, I think the just non-qualified accounts where I go and invest in stocks in just a regular brokerage account is a very underutilized area today because of the lower taxation of long-term capital gains, and qualified dividends can be much less than regular income, which is simply what income coming out of my IRA account is taxed as.
Right. Oh gosh. Again, a lot goes into this, and we should present this is $18,000 per person. So a
Yes.
married couple could actually give away $36,000, right? And not incur that
Per
gift tax
individual,
limit.
right.
Right. Yep.
Yep.
All right. Well, I know you mentioned in the last segment too, you kind of teased this up, Dale, about people reaching age 70 and a half. So let's talk about qualified charitable distributions, because we just talked about the gift tax that applies to friends and family that you may want to give money to, but what about charitable gifts?
Well, it's, qualified charitable distributions is something that's is a holdover since they've moved the RMD age a couple of times in the last few years. But you can still, at 70 and a half, you can still give money from your qualified funds through qualified charitable distributions directly to a charity. The great thing about it is, especially with most people using the standard deduction on their tax returns, it allows them to give money on top of it that they really weren't getting credit for if they were using the standard deduction on their taxes.
The other beauty too, Kristen, I just want to make sure is people will often look at what the RMD amount is, and it has a number, and they'll go, "Oh, that's how much I can gift." No, folks, $100,000 is the max that you can gift.
Yeah, it's $104,000 for
yes.
2024. It went up a little bit this year.
And so it goes up. Now, we don't see that happen that commonly.
Sure.
But the reality is that's not the limit you have the ability to do. But as Mark just alluded to, is if I can take a roughly $30,000 or $29,200 standard deduction, and then I do all of my giving outside of that situation, it's almost like I'm adding that on top of that standard deduction of getting money out of my situation that at some point I'm going to be forced to take, again, in an efficient manner.
Yes, and it's allowing the IRS not to touch it. The key is you don't want to withdraw the money, then gift it to the charity, because you're going to have to pay tax on it. But when you do it directly through a QCD, then you don't incur the tax liability, and the charity gets the full amount. So it's a win-win situation for both parties involved. I know you work a lot with folks who have charitable giving as part of their lifestyle, and so I know you help folks do these QCDs quite a bit.
Well, and there's also another common misconception that people think it has to be large gifts, and it doesn't. I mean, if it's $4,000, $5,000, $6,000, that's literally an amount that you have the ability to get out.
Right.
It implements in with the Roth conversion strategies as well, because one of the purposes of the Roth conversion is to get money out of the plan before the government forces me to. Okay, that's traditionally the idea. But having the ability to get money out through the gifting means I don't have to deplete those accounts completely, because if I know I'm going to gift $10,000 a year for another 20 years, there's $200,000 I know I don't have to take out to pay taxes on, because I'm going to get at it later.
And again, this is why engaging in that proactive tax planning is so beneficial.
Well, it is, and it does work along with Roth conversion strategies. And if we've got people that are doing these QCDs, then we're actually going to be apt to leave some money in their qualified funds to continue to do that, so you don't have to convert as much.
Right. So smart. Again, all these pieces fit together, right? Well, let's switch gears a little bit now. I know the next item up on the list is life insurance proceeds. So talk about why that is on the list for non-taxable income.
Well, I mean, for most life insurance death benefits you receive, you're going to receive, those are going to be tax-free, to your beneficiaries. So, those are dollars, and then if we're getting accelerated benefits, maybe for long-term care or something out of that, those too are received to you, in most cases, tax-free. So those are dollars that you don't have to pay taxes on. So that's,
Well, and that can be one of the more efficient ways for people that have not addressed the long-term care scenario as well. And I know this is getting a little off topic, but I think it's so imperative in this situation, because we see people all the time that walk in and they say, well, what do you think about long-term care? And they're like, well, gosh, I've priced it, or my parents are paying for it.
Meaning long-term care insurance, right?
Traditional insurance.
Right.
And then they have plenty of money in a qualified account. Well, the idea is that we can do the conversion. Instead of necessarily putting the money inside of a Roth IRA, maybe we fund a cash value life insurance policy that has living benefits, where someone has the ability to literally utilize that death benefit at some point in the future while they're still alive to cover those needs. Then the death benefit still pays out. Almost every scenario we've ever looked at, you're almost always getting all of your money back. And sometimes there's even a positive net return for that same approach. And it's literally, Mark likes to use the terminology, making dollars do more than one job, where maybe I'm literally accomplishing 2 or 3 different jobs with the same dollar amount potential by giving myself additional flexibility.
And unlike traditional long-term care, if we paid the premiums in and we didn't use it, those dollars are just gone.
You lose it, right? Yeah.
But with this using life insurance and products with long-term care solutions in there, somebody's going to get a death benefit even if you pass away before you've used it.
Right.
Now, is what you all are referring to in the context of what you just said, are those 7702 plans? Is that the term for them?
Well, it can be utilized for that.
It can be utilized for that, yeah. Because I think this is another interesting thing. I have a stat here. This is why I wanted to bring up 7702. It's a type of life insurance that over 85% of Congress members have. Over 90% of senators have them. Our last 6 presidents have had one, and yet most Americans have never heard of what a 7702 is. I think that's a problem, right?
Well,
Clearly, they know how to help play the tax game,
Well,
right?
here's the reality. There are a lot of investment opportunities out there that have been inappropriately maligned over the years. It's this is bad or that is bad, and it's typically by a company who doesn't offer those options. I'll go ahead and tell everybody today, I'll let the cat out of the bag. As independent folks, we're never going to take a solution that may work for someone off the table. It also doesn't mean that we're going to offer every solution to every person.
Right, because it may not be in their best interest.
That's right. We are not mandated by someone in, I'll leave the town out that would normally utilize because you would know who I was referring to, in that by being mandated by somebody to meet some kind of a goal, to meet some kind of production bonus or something of that nature.
Right.
It's only what is the right solution. But the reality of it is there's certain things out there that are going to guarantee income for life, and some people need that, and there's only very few options that allow that to occur.
Wow. Again, so much goes into this. It really depends on each person's individual conversation. So what would you say to our viewers who are needing some help navigating how they can remove their wealth from Washington?
Well, here's the reality of what I'll say to everybody. I believe our education system and our government has purposefully kept us ignorant about how taxes work over a lifetime. If your entire understanding of your tax situation is, did I get a refund back or not? Believe me, you don't understand how that works. Please give us a call today, scan the QR code, reach out, let us look and assess your particular situation and help you understand how taxes currently are affecting you and what are some possible strategies that we can implement to add value to your situation over time. Would love to sit down, 2 complimentary meeting process to help you understand how to better utilize and become more tax efficient.
Wonderful. Dale, Mark, thank you so much. I think the reality, and what I'm hearing you say too, is that whether we realize it or not, you can settle for the government's tax plan for you because they have one.
Oh, yeah.
But you can take proactive steps to get a better plan in place for yourself to potentially eliminate and reduce your potential tax burden in retirement. So again, to receive your complimentary tax review from Dale and Mark and the team of Retire Path Wealth, simply call that number you see on the bottom of your screen, 866-724-3893, or again, you're also welcome to scan that QR code, and that will get you connected as well. We'll be back with more right after this.
We're based in Little Rock, Arkansas. We're licensed literally in 37 states, though, so we can reach across the realm. The greatest benefit of being independent is simply choice, but always having basically the entire investment universe to go search for the best answers for individual clients and then helping to narrow that down. We do a very solid job up front in our data gathering process of not just getting information, but getting a sense of feeling what a client's real objectives and long-term goals are based on where their finances are. From years and years of doing what we believe is simply doing the right thing, we're going to find and get that answer for you, not, hey, here's someone else you can call, see if they can answer this question for you. We like to have those resources on hand.
Well, welcome back to Arkansas Money Talk, where today we're discussing how to remove your wealth from Washington, how you can potentially reduce and eliminate your potential tax bill in retirement. We don't want you paying any more to the IRS than you are legally required to pay, and we've been working our way through some of the different types of non-taxable income that the IRS can't touch. We've got several more on the list. We'll see how many more we can get through throughout the rest of the show. Next up on the list are some capital gains and losses. Let's talk about that briefly.
Yeah, so long long-term capital gains are typically our friends here. So I've held an asset for more than a year before I've sold it and made a gain on that. The other reality in a year of volatility such as this, there may be some tax harvesting opportunities. I may have certain positions that I bought into maybe here in the last couple of weeks, and this current market adjustment has now got me at a short-term loss, where I can sell some of those, reposition my assets, and take advantage of writing that off against my income as well. But back to the long-term capital gains, if I'm in a 12% or less income tax bracket, that income can be taxed at zero. Zero is the best bracket to pay my income taxes in. Okay. Again, qualified dividends. I mean, so typically dividend rates, here's the beauty. The last 2 years, we've kind of fallen in love with higher interest rates. We've literally had people come in whose taxes have been so dramatically affected simply because they had money in money market or in CD accounts that have earned nothing, and then all of a sudden the last 2 years they've earned substantial income, and they go, oh my gosh, I realize now all this gets taxed in these brackets. Well, with interest rates possibly trending back down, a lot of these stocks that a lot of these investment options we're talking about here have a dividend yield that's paying dramatically higher than what even current interest rates are. So there may be a great opportunity to go out there and buy some of these old line companies that pay dividends that have a higher cash flow even than money market or treasuries do today, with possibly a lot of stability. Not only that, if they're qualified dividends, maybe I pay it at zero instead of as regular income. Boom. Huge advantage opportunities that are out there.
Wow, and that's why it makes it such a time-sensitive conversation now, too. A lot of folks are navigating these higher interest rate environment and encountering some of these things for the first time,
That's right? Well, and what we see, and in fact, I had a phone call just last week, you have people, a lot of people we talk to already have advisors, and they oftentimes just say, their advisor just says, the taxes are what they are. And there are a lot of things that you can do to help minimize your tax obligation.
Well, and the major difference in what Mark just says is somebody's got to take the time and the effort to do it.
Yes.
Okay.
Yep.
And so many times, and I think we've talked about this, especially in a Medicare scenario where there's drug plans out there that don't pay commission, so nobody talks about them. The same thing here is that, oh, well, you have those accounts over there. They're not something I'm responsible for. The reality of it is we are true believers that if you give us access to a certain portion, you're going to wind up eventually bringing everything in anyway. Because you're going to want it all handled the way we're handling what we're taking care of for you. But the reality is that taxes are the largest fee that anybody's ever going to pay.
Yes.
On any investment structure out there. And so if we have the ability to mitigate or lessen the effect that Uncle Sam or the state or whoever it is has on your outcome, we literally have the ability to increase your rate of return over time without taking additional risk, just by simply being intelligent of how we do things.
Right. Well, I'm so grateful we had this conversation. We could easily do a whole nother show and get through the rest, but Mark, Dale, thank you both so much. And here's the reality. It's not about how much you have, it's about how much you get to keep. If you would like to be able to receive that complimentary tax review, again, the number to call is 866-724-3893. We love you, Arkansas. We look forward to being back with you next week here on Arkansas Money Talk.